All right, everyone. So we're going to get started here today, picking back up with chapter 4. Before we do, I have some real life footage here of Uncle Steve, which you guys aren't going to believe because this is some crazy stuff. So that's him right there. He's just barely holding on. Now I want to show this to you as a reminder of the flow state. That's the state of mind that we all look to achieve as traders, to be able to be so in the zone. These are people that have such an incredible command of their skill. He's not thinking consciously, I need to adjust my balance here. It happens just naturally. And just like the person flying that helicopter, his ability to move up and down, and everything else, these things happen naturally. Now, getting to the place where you've actually developed so much of a skill as a trader that you are able to essentially trade from intuition and from that flow state where you're jumping in, jumping out, you're riding the momentum, and you're in the zone. You know what to do. You don't have to overthink it. That is the culmination of a tremendous amount of time sitting here watching charts, a tremendous amount of practice. Right now, we give Uncle Steve a hard time around here, and I can't imagine how fun it must be to be in class with his number one favorite nephew. It's got to be just something else. We've been talking a little bit about Uncle Steve's hairline. And just as a public service announcement, I've got a picture here of Uncle Steve. How old would you say you were in this picture, Uncle Steve? Maybe, and look at that full head of hair. Can you even remember how it felt to have that kind of hair? So I'd say, I don't know, maybe 17 years old. And this is a reminder of why you have to start the Rogaine early. This was Uncle Steve. So let's see. This was him at, I'd say, 17. Oh, he's saying he thinks maybe 15. Well, this was Uncle Steve at 20 years old. When he turned 20, the hair was gone. Can you see the resemblance though between me and Uncle Steve? Same beard. Now my hairline, there's no resemblance there, but we look quite a lot alike. So this is just a little after his 20th birthday. So this would have been in 1917. 1917, yeah, that adds up. All right, so we're giving Uncle Steve a hard time. He's the best uncle, and he's also really excited to learn with you guys. So let's see if we can help keep Uncle Steve on track. And don't forget to apply a little bit of that Rogaine before each class. Okay, so we're going to get in here with Chapter 4, Part 1 on daily chart patterns. Okay, so we're going to continue what we've already started, which is the anatomy of a strong daily chart. We're going to talk about moving average, support and resistance, daily windows, drawing support and resistance trend lines, daily flag patterns, and former Momo stocks, former runners, former big momentum stocks. In this section, we're going to go a little deeper than we went in the starter. I'm going to show you more examples, and I'm happy if any of you want me to take a look at charts for me to take a look at a specific chart. So why is this important? Well, again, by focusing on strong daily charts, we are further reducing our risk. And ultimately, we know day trading is risky. So anything we can do to reduce our risk is only going to help us be a little bit more successful. So the key levels, learning to anticipate the breakout levels on a chart. That means you're learning to expect where you'll see volume come in. So just for instance, if you know the first candle to make a new high, the first daily candle to make a new high is, let's say $3.50. When you start seeing the stock come up to 345, 347, 348, it would be reasonable to expect a surge of volume right around that level because of the importance of that apex point. So when we talk about apex points, I'm usually talking about the price down to the penny where a breakout should occur. Now, sometimes the breakout doesn't occur And we would then say it was a false breakout. And it doesn't mean that we didn't have the right idea, but it just means that other traders weren't interested in that same setup. Remember that stocks really only go up because people buy them and go down because people sell them. So that's why we want to always focus on high relative volume. But even then, there will be times where we're just wrong. So we learned to anticipate the breakout levels on a chart where volume will come in. By anticipating these levels, we have our orders ready to buy just before or just as the volume begins to pour in, as the stock is spiking. This allows us to get the maximum profit with the minimum amount of waiting time. And so in a way, it's kind of like it's trying to find instant resolution. And as a tangent, and Uncle Steve shared this story with me just the other night, which I knew a bit about, but our grandfather, well, his grandfather, my great-grandfather, but I never met any of my grandparents, so whenever someone says grandpa, I'm thinking of the same person. I never met any of my grandfathers, I should say. In any case, Uncle Steve's grandfather, my great-grandfather, had just gotten his seat working on the stock exchange in New York City in 1929. He was 34 years old. And he was there on the day of the big crash. And from everything that Mom has told me, and Uncle Steve and my Aunt Debbie about that, it had a very powerful effect on him. It really, well, I suppose like it would for anyone, it changed him. And he moved into a different line of work as, I guess, an insurance kind of salesman, and moved from New York City back to the Boston area, which is where our family was from. And then when he was in his 50s, he threw in the towel and retired and moved up to Vermont to live a simpler life. Had a farm, and that's where he sort of spent the rest of his life for the most part. So his experience losing all this money in the market, a couple generations later, it filtered down. So, I was talking about how Granny, or my mom, she has that old ledger from the 60s. She's all of these things she saves. And it's one of these kind of, I think, pack rat mentalities that a lot of people who have gone through a period of struggling experience. And so when I got into trading, I was really afraid of risk. And because I was afraid of risk, yeah, I see that on the camera. Because I was afraid of risk, one of the ways I wanted to reduce risk was taking trades that were as short as possible. Anytime I'm in the market, and I'm just holding a position, I'm sitting here afraid, and it's hard for me to look away. I can't hold positions overnight because I just keep thinking and wanting to check, and it creates a real discomfort for me. And so because of that, I was seeking out a strategy and a method of trading that was very quick, where I could minimize that discomfort of holding a position and the feeling of exposure, risk exposure. And so that meant I had to focus really on these apex points. And that ended up meaning focusing more and more on stocks that had news and stocks that had really clear catalysts. And so, what's kind of ironic is that I'm a risk-adverse person. I don't like to take really a lot of risk in the market, but I'm a day trader. And my feeling is that because I have it so dialed in down to the penny, it feels less risky to me than just putting money in, just walking away and leaving it, even in something like the S&P 500, because your downside risk is 30%, on a really bad year, maybe 50%. Your upside potential is typically, 8 to 10% average. So anyways, so what we're coming back to, and what we're going to keep coming back to, are sort of these, these little things that I guess happened in my life, or even in the lives of my parents and their grandparents, their parents, that have all sort of shaped my personality, and my strategy is a reflection of that personality. So when we talk about daily charts, we're really often going to be talking about levels really down to the penny. So some traders believe that you have to have a strong daily chart in order to trade a stock. I used to believe that, and then I just kept finding that there would be times where you would just have a stock that had a terrible daily chart, but would still make a really big move. And so for that reason, I've learned that a really good catalyst can override a poor daily chart, but a poor catalyst, is not stronger than even a great daily chart. Ultimately, what's more important is the intraday catalyst. So you could have a stock, for instance, that has an amazing daily chart, but no catalyst, and you probably won't get any follow through on that chart pattern. It only helps, obviously, if you do have a strong chart pattern and a strong catalyst, but there will just be times where we do have kind of a weak daily chart, but the catalyst intraday is so strong, that that's what's most important. But again, perfect setup has a strong daily chart, and it is important at the very least that you understand what a strong daily chart looks like so you can help kind of measure, what are we looking at here? Is this strong or not? So indicators of a strong daily chart for a small cap stock, the price should be above the 9 and the 20 EMA. And in the case of a stock that's gapping up 5%, it almost always will be. Ideally, the price will also be above the 200 EMA. But as we've talked about, this is not required, and I'll show you instances of why. Ideally, there should be large gaps and windows of no resistance. Sometimes that won't be the case, but that is pretty important. There should be no obvious ascending or descending resistance lines that are in the way. A stock that has blue sky, which is our kind of, casual way of saying it's at all-time highs. So a stock that's blue sky is at all-time highs, meaning there's no upside resistance. Doesn't mean it'll go infinity, but there's no resistance. And then 6, a history of being a former runner, a former Momo stock can create a big move that you might can create a bigger move than you might expect from the same pattern on another stock. Just because the stock has this former Momo history, people are going to jump on it a little faster. Now, I wouldn't worry about daily chart watch lists. This is something that, I don't sit here at night, every single night, and, go through, you could do however you wanted to. You could go through just stocks that you're familiar with and, check all of the charts, or you could go through, stocks perhaps that were on the scanners from today and go through all of them. And it's fine to look at stocks that were among the top gainers of the previous day or of the current day. So if we look at top gainers here, these are certainly all worth watching, just kind of keeping an eye on, because, if it was a top gainer today and it closes near the high, well, this may be a continuation setup for second day of momentum, which we talked about yesterday, continuation days. But generally speaking, I don't sit down and start just pouring through charts of any stock that's up, 5% or whatever the case is on the day and start to break things down. I just always wait till the next morning to do my watch list. And there's definitely people in the past who have said, Ross, why don't you do your watch list, at night so I can see it and don't have to wake up as early? Well, I don't know what companies are going to put out news tomorrow, so I really can't. So again, typically a great chart will end up having very little follow through and not a lot of volume and poor follow through unless it has a catalyst. So instead of making daily chart watch lists, spending your time reviewing the trades you've taken on the 5-minute chart from the previous day would be a better use of time. And if you, watch live trading archives, perhaps of my trades from that day, that would be a better use of time. Rewatching the stocks that you just traded or that were hot today to evaluate, how could I have traded them better, or, where other places maybe I could have found entries or avoided losses. That is a really good use of time. But scanning through tons of daily charts, not a great use of time. So the criteria for a good daily chart should, again, only be applied to the right type of stocks to trade as per Chapter 3. So number 1, moving averages. So tell me what would be a problem with trading this stock. You can see that we've got our magenta 200 exponential moving average right here at 393. Now, we know different trading platforms will sometimes show the prices in different places, so you may have to and you may choose to use different colors than what I use, but this is a problem here. So the stock, if we saw this would have hit the scanners, because you can see on this day it went from about 250 to 380 or so, 375. So as it was squeezing up, it would have been hitting the scanners. The stock ticker is DCIX. DCIX has... looks like might not be listed anymore. So this one I know had a pretty low float. It was a shipping stock, container shipping stock. So, it's a stock that was a former Momo stock here. You could see from $2 to $7, but then obviously dropped. Another day it popped up, gapped higher, and then broke back down. So on this day, I would say, you know what? I can't buy it at 350, knowing that this critical resistance level is only 40 cents away at 393. It's just too close. Now, if it's at 388 and there's a lot of volume, then I might take the trade to anticipate that it will break through it. Of course, the best time a stock can break through a critical level like this will be when it has high relative volume and has some type of strong catalyst, and usually earlier in the day when the volume and momentum is stronger. So I guess we'll sometimes take a trade to anticipate that it's going to break, but I wouldn't trade a stock. I try to never trade a stock without at least knowing the position of the 200 moving average. And in this case, it's a problem. Now, just going back real quick, our 9 moving average is the gray line and the 20 is the blue line. And you can see that it didn't take too much for the stock to be above that level, which is good. But realistically, you've got the 50 there, and you've got the 200 a little bit above it, and you probably have the 100 in between. And it's just not usually, to me, worth trading these ones at this point. So here's another example of a stock that is below its 200 moving average right here at 495. So 495 is the magenta line. It's below that level. Now, if it gets above that level, you can see we've got some room here from 9, a window, up to 1365. And then a little bit of room here, a nice window from 1461 up to 2175. So it's a chart that certainly has some potential, but where it sits right now doesn't work. Now, if on this day it was gapping up to 6, then it's already gapping above that level. So then we're fine. But if it's gapping just up to 480, maybe I would say, okay, maybe it's worth a shot to try to anticipate that it will break through the 200, but it's not a perfect daily chart really until it gets closer up into these levels. And yes, these are just daily charts that we're looking at right now. Chapter 4 is on daily charts. So here's RKDA, and here's another example where on this day, the stock is clearly below its 9 moving average, its 20, its 50, and its 200. Someone might say, oh, this could be a dip trade. Well, yes, it could be, but generally, I try to be careful about trading the backside of momentum. So usually when we're talking about momentum, when it's first ramping up like this, we're clearly moving up, right? And when we're starting to come back down, this is sort of on the backside. So a move like this, a pop, that obviously is a day that it didn't move nicely. Those can provide some opportunities. But this would have certainly been on the backside of the move. And what you often have happening on the backside of the move is that people who are perhaps bag holders and are underwater will be marketing out on a day that the stock does pop up a little bit because, hey, at least it's, up a little bit off of its lows. And short sellers who sort of see that this is just sort of a little pop off the low might try to reposition for a new short. Now, some short sellers who got in too low will be forced to cover. So you can have a little short squeeze as it comes back up. Often we see people short these and then they come lower. So I try to be a little careful trading the backside of the move. And you can even say that on an intraday basis as well. If you've had a stock today, let's just say, for instance, we had the stock Lizzie that made a pretty big move up right here. But, once it failed right there, now this sort of stuff is kind of on the backside. Perhaps this could have formed a 5-minute flag pattern and given us another opportunity, but that was a pretty big extension. We already had the first pullback and the second. We know we usually try to be cautious around third. And this case, you had such a sort of parabolic squeeze there that they don't always pull back nicely off of that level unless it's the only stock people are focusing on. And today, I think people were focusing on different stocks. But in any case, this is not a good daily chart because we're below our moving averages. Now, this in contrast is a little bit better. The price is above its moving averages, above the 200 certainly, and you can see how this stock respected the 200, bouncing off of it here roughly, certainly bouncing off it right here, and on that day giving a nice squeeze. So this is a totally fine daily chart, and we would probably say that over $10, over 11, 12, and certainly over this level of like 12.25, it starts to look better, but this, unfortunately, is one of those daily charts that has a topping tail, then a big red candle, and so you know that there's going to be some traders that are trapped on it. In other words, that are holding it at these high prices that perhaps average down to reduce their cost basis, but ultimately would be probably happy to get out break even if it comes back to 14. So as it starts coming back up, we may see resistance as it hits those levels. This is another example of a daily chart. Oops, wow, that was loud. This daily chart here has resistance right at the 200 moving average. This was the S&P 500. So you can see we dropped, sold off, and then we came back up to this critical level. All right, so critical level of resistance there at 293. And if you hadn't seen that level, then naturally you might not have known to be careful being a buyer as it was approaching it right here. So by seeing this level, it allows you to be a little bit more mindful when you're thinking about your trades. Here's another example, APVO. Now in this case, we did break through it. And what happened on this day is that it squeezed up, it broke through it, and then it did this false breakout at $9 and came back below it. And so at that point, I knew that it really didn't make sense to try to go long because we had crossed over this critical level on the daily, but then we were right back below it. And so I was like, no, this isn't going to work. This is not going to be a safe one to try to trade. Now, again, on the first move up, the previous day was good. This was a continuation day, so that was fine. But then as it broke this and came back below it, that was a problem. Here's another example of resistance at the 200 moving average. Again, if it can get back above that and break over 5, we've got some nice room here back up towards 6. But until it gets over that level, we're just going to have a little bit of an issue. Here's a perfect example, very well established. You've got the 200 moving average and it taps that almost to the penny. Now this stock also had a little bit of a problem on its daily chart, which is a history of gapping up and selling off those high volume red days. So anytime we see that, we can also be a little bit more cautious. A history of these topping tails. So, is this a stock that we would say is a former runner or former momentum stock? Yes and no. I mean, yes, it does have these days that it makes big moves. It had a couple really nice ones back here, but more recently, it's not been that strong. So on this day, yeah, it went from $2 to $2.73, but then hit that level. I would have been very cautious on it. Here's another example of a stock, and in this case, a recent reverse split. So my chart right here actually shows the reverse split. So if I go to the daily chart, you can see this is a stock that has one reverse split here, another reverse split here, another one there, and that's about it. So this is a former Momo stock from 2017. In 2017, this stock made a huge move. This was one of the shipping stocks, but it created a lot of bag holders up at the top. High is now showing as about $24,000 a share, adjusted obviously because of the reverse splits that were done here and here. But it does have a little bit of a history even in these areas of popping up, but it's just such a weak daily chart. The thing that I will say though on a stock like this is that while this daily chart is really weak, because the float is so low as a result of these reverse splits, these stocks sometimes will put in these bounces off the low where all of a sudden they squeeze up 100, 200% and all of a sudden force high degrees of short covering. You would have to do a little research to see to what extent these stocks had short interest, but if they had a high level of short interest and had that type of history, on the day that it was gapping up, it may be worth watching a little bit more closely. So to put these on my chart, I actually would have to go, let's see. Whoops, what did I just do? Okay, so that's the candlestick chart. Let's see, it's under right click and then properties, and then I show the splits. So just by checking on that, I have the splits. And look, that was a 1-to-100 stock split. So that reduced the float. The float is 1/100th of what it was before that stock split, just for reference. All right, not all charts will show that. eSignal does, and that's definitely nice because then very quickly we can see, oh, it's a recent stock split. So MBRX today, for instance, which is the stock that I'm up the most on, 16,000, it was a stock split yesterday. So they did a 6-to-1 stock split, reduced the float from about 60 million shares down to about 10, 12 million shares. It is a little bit of a former kind of pop and drop stock, which is not great, but the recent reverse split plus a catalyst today, it was certainly worth a try. And knowing that it has had times where it's made big moves, we got something on it, which was good. All right, so back to here. So here's another example, running into that moving average. So, on a stock like this, I'd probably be fine with trading it, at 354, 450. But as we get up towards 5, when we're within 50 cents of that level, I'm going to start being concerned about that resistance. And just as a tangent, I see some of you asking the question of, can you trade directly from eSignal? Yes, you can enable that with certain brokers, but I don't like to add any possible areas of latency in my trading. So I never like to use APIs. I just like to trade directly from this platform here. And if that means that sometimes, you know, I have to enter the stock once here and then enter it again in my Lightspeed to open up the chart, then I'll enter it twice. I still feel like that's faster than trading through an API where this is having to get information from Lightspeed, and therefore there's room for lag and error. And I just can't afford that. So here's another example of a stock that squeezed up off the lows up to the 200 and is hitting that resistance level. However, the daily chart is also interesting because what do we have in this blue box? We have a gap, a large gap from 329 all the way to 850. And so we have this nice gap here. And so we would possibly be thinking about the potential of gap fill, but the 200 moving average comes down and kind of cuts right through that level. And so it effectively reduces our profit target from 850 down to, well, about 650 right there. Now, if it can break through that level, you know, then that's different. And maybe, you know, again, maybe there's something more there, but until it can break through that level, it's not going to be something I'd be really interested in. BLIN here, again, resistance right at that 200 moving average. So you see how it hits that level, resistance right there. So again, that's something that, you know, I just wouldn't want to be trading right into that level. Now, this one also has the problem of being a cheaper stock. And so even if it does break that critical level, the 200 moving average, realistically, the next target's only 218, the high of this candle, we're not talking about a lot of room. Then you've got a big window from 227 up to 375. But again, you know, maybe as it gets up there, it's better. But then you've got this big red candle, so that's a little tricky. So here's an example, and this is a kind of cool one because this shows you the daily, the 5 minute, and the 1 minute. So on this stock, it ripped from 750 to 850 up to 1050 and taps at 11. So on the 5 minute chart, how did I know that there was possibly going to be resistance up here at 11? Well, the 200 moving average is 1113. I can see it right down here in the corner. And so we came up to that level, we hit our head on it, and we faded off that level. This is also a stock you can see that was a recent reverse split right there. So we've got the recent reverse split. It makes this big squeeze. This is obviously a nice move, but now it sells off. And as it comes back up right here through 930, 940, and up to 10, we just know that it still has this level of the 200 moving average that it's below. And that if it couldn't hold above it here, the volume here, I don't know. I mean, maybe, but we just know that that's a risk factor. All right. So in addition to at least checking the position of the 200 moving average, we want to look for gaps in windows. We know gaps in windows are areas that have no resistance or support, essentially. So the stock, when it gets into those gaps or windows, can move quickly. A good window or gap should be about the average range of a typical candle or bigger. And you can just eyeball it. You know, you don't have to necessarily use the actual average true range, but if an average candle is, you know, about this big, then you can definitely interpret that, okay, this is a good sized gap right here, you know, and that is a nice gap that we'll, you know, I suppose keep in mind, but of course that would be more as it's coming back down, whereas, you know, the gaps going back up are sometimes a little bit more interesting. All right, let's see, let me move this away. All right, so this is a chart where I've drawn out sort of all of these gaps and windows. Some of them are in green, some are in red. So don't worry about the colors on them. So right here we have the high of 1176. Then we've got room up to 1366, the high of this candle. Then we've got a gap up to 1583. And then that's kind of the top, which is why I made it red. It's because we don't really have any, this is not a window up to 1892. This is just kind of, there's these little levels here, but they're not super clear. There's not anything big there. Then we've got a little window from 1892 up to 20. Then we've got another window from 20 up to 2150. And then again, red, we kind of just run into this little area where there isn't really a lot going on. And then we've got another window here from 27 up to 30, a gap from 30 up to 34, and then a little room here up to 36, and then again, kind of not a lot until we get back above 39. Now, you don't have to color your lines like that if you don't want to. You certainly can, but you don't have to. So the ATR, average true range, just for reference, it's the average price range of a stock over a period of time. So I think you can set your ATR at 14 days or at 30 days or whatever you want, but it's the range of the stock over a period of time. So for me, I usually don't use this as an actual indicator on my charts. I could go right click, I could insert study, average true range. And if I do that, this will tell me the ATR of this stock is 74 cents. So that's its average true range. Now that's based on a 14-day period. All right, so if a gap is bigger than 74 cents or a window, then it may be worth looking at. But just because it's 73 cents or 71 cents doesn't mean you should ignore it. So, and just because it's 77 cents doesn't necessarily mean it's going to be a really good one. So I try to just kind of eyeball it. So when we're looking at the daily charts, remember we're looking up and to the left. So up and to the left, just like, was it? It's like JFK, Dealey Plaza, just slightly up and to the left. So that's what we're looking for. Now, let's pull up a couple daily charts here. So in this one, for instance, we look up and to the left, right? And then we look up and to the left. And then we look up and to the left, up and to the left. And so right there, we've mapped out our critical levels. Now, each one of these, to me, is a possible trigger, but could also be a resistance point, because if we come up to 1182, we're coming to the top of that gap, right? Or that window. So whether it's a trigger or a resistance level, they can sometimes be either, but I would typically say the trigger is the price right where the window begins. It's the price down to the penny on the daily chart where you think a massive breakout could occur. And it should be obvious, not just to you, but it should be just so obvious that you think other people see this same line. So every retail trader should be able to see it, maybe even institutional traders as well. The more obvious it is, and the more higher the relative volume on that stock, the better the follow through will be. We don't want to overcomplicate it. So when it comes to a trigger versus resistance, sometimes that obvious level of 930 ends up becoming resistance. As it actually literally was today. The high of day today was 930. So it was not able to break that level. But it became resistance, but it was also, if it had broken that, that would have been the trigger for the move up to 1182. So you can see how these can be perceived both as resistance and as a trigger at the same time. I would say that in some instances, you're definitely just looking at resistance and it is not a trigger. Let's say this chart's not a good example of anything like that, but maybe General Motors, we'll just pull up kind of a random chart. Maybe we would say over 53, 59 is a kind of a trigger. It gives you room up to 55, but then you've got room just only to 55.77 and then kind of more resistance here. So maybe we would say there's a window here up to 55.16 and then that's kind of the resistance. That's sort of the top, because then we get into this area with very tight nearby resistance levels, and those, because they're so close together, we wouldn't call them triggers at that point. What's another chart that maybe I could give you a better example of? Let's see, let's just look at Lizzie from today. This one, because it's so open here, let's see, to the left and up. So 55, I wouldn't consider 55 to be a trigger because 64 is the next level. So is 55 resistance? No, not necessarily. It's just not really a significant level. But 64 is more significant. If it can break that, then we've got room here left and up to there, and then we've got room to 896 and then 9. So again, kind of two little levels stacked together there, and then another small level right there at the bottom of that gap at 907, and then it starts to break through. So in this area here, I would say that, we've got a little bit of resistance between 896 and 907, and then above 907, it starts to look more like a trigger for a move higher. So this is an example here of a good daily chart. This does have some cons, which are some moving average resistance levels. You've got the 20, the 50, I'm not sure where the 200 is. You do have a big gap from 1821, 1556, so a nice gap coming back up for sure, but you've got moving averages cutting in between that level. It's also a former momentum stock. although it's not actually, only sort of. You know, Pandora has a higher float, so while it is, yes, kind of a former momentum stock, it's not. What is the float on Pandora? Did Pandora get taken? I can't even pull up the stock. I don't remember now. Pandora looks like maybe they got taken private. So whatever, it's fine. But yeah, so you could see this one. It's not a bad chart. If we saw that on a stock with a lower float, we might be interested. This is a nice one. You can see a gap here from about 550 up to 17. But again, you've got some moving averages cutting across it. It's not really a former Momo stock. That's also hurting it a little bit. Now this one's nice. On the one hand, on the con side, pros and cons, you've got the huge gap down. So that creates a little concern because you may have some bag holders who were caught into that halt down. And it wasn't all that long ago. You know, it was still in the same year. Once it's years ago, then you usually figure, you know, if you're sitting at December 20th and this stock looks like a loss, you may just be inclined to cut the loss at the end of the year because that way you offset the loss against your gains. We'll talk about that more when we get into taxes, but usually if people are holding a position and it's just clearly not coming back, they may just say, well, you know what, at least I can feel good about offsetting my income with a loss. At least I get something out of it. So around December, you may see some selling on some of these weaker names, but in this case, this is April and now we're in July. So you don't have that benefit that maybe those people have kind of already bailed out. So you could have some resistance coming back up. However, over 304, we have a little window there to 323. That's a small one. And then from 323, you've got room all the way to 858. Yes, you do have some moving average cutting across it, but because they're definitely spread out because of how big the drop is, you do have a lot of room. And it's a former Momo stock. So if it starts to curl up, you may get some momentum on it. BLNK, all right? Not a bad daily chart. Running into resistance here at this point, but from the previous day, you had a nice window from 329 up to 850. Then resistance at that moving average at 661. So like we said, we saw this earlier, cutting the gap across here, but a good daily chart from the move from 329 up to that level. AQXP. This is a stock that, well, I guess at this point becomes a former Momo stock, but not really former Momo in recent history as of 2015 when I grabbed this chart, but a window here above a gap from 381 up to 655. And on this day, it just surged right through that level on very high relative volume. So, you know, and above 655, maybe room higher, but look how it hit that level almost to the penny. And so to answer your question there about determining whether or not a stock is a former runner, former Momo stock, for the most part, I can just pull up the daily chart. And, you know, at this point, Lizzie, after today, I don't know. It depends how it closes. If it closes red, that's not going to help it. This one wasn't really a former Momo stock. It had a couple of days back here, but not really. OCGN, this one, big sell-off, but, you know, a couple of big days back here. You know, what are some others? Jan, this one put in a really big candle last week. So, but then of course it was red off the top. Previous to that, you saw that it did have this area where it went up 100% in a short period of time, but of course also had these red candles. So usually what we're looking at is within the last 6 months or so, do we have some really big green candles? And if the answer is yes, then, you know, that may be a stock worth watching a little bit more closely. LEDS, for a while, we would have considered a former Momo stock because of this big move here. We have a big green candle, and yes, it sold off, but we still had that big green candle. So then former Momo stock news, it does it again here and here. But then it got into a little bit of a habit of gapping and fading and has not been as strong recently. So really, we just kind of look back at the last few months. And you can check the volume bars and see if there's high green volume candles. That is sometimes a quick way to draw your attention to the right candlesticks. So GLBS, former Momo stock here at the time of the screenshot, 877, room up to 1950, and then room up to 24. Again, you know, that bounce off the 200. So that's a very clean, nice looking daily chart over 877. The big red candle does imply probably some bag holders. SSH, So this is not a great daily chart. You can see how it's certainly below the 200, but it's also below the 9, the 20, the 50. It's just selling off. Yes, it was a former Momo stock, but at this point, it's given up too much of the gains. APTO, not really great. Yes, there's a window from 350 up to 430, then a gap to 531, but you've got the 200 right here at 350. So until it can get above the 200, it just doesn't look all that great. MIRN, I just don't see anything there. It's below its moving averages. It's light volume. There's no clear pattern. You know, I just don't see much that is interesting. Now, a possible setup that we can't see, if we opened up this chart more, it's possible that we would see that this is actually near its all-time highs. Maybe. The fact that the 200 moving average is this short means that there's only 200 candles from this point back. So this was a somewhat recent IPO, is what I would interpret. Otherwise, we would have a full 200 moving average, and this one's shorter compared to some of the others. So this is 200 candles, so it's always looking back 200. I mean, you could set it up different ways, but that's how it often is. CHEK, you know, you have some room here from 497 up to 867, but it's got some moving averages. The 200's up here. You know, if it can get through those moving averages, maybe it starts to open up. It's a little beaten up and it's below the 200, but maybe. It is a former Momo stock. Reverse split from back there. Bad daily chart on this one. I don't see anything I like. So just like, you know, you start to be able to read, what are the waves looking like today? Or do we have some great waves today, some great action? Or, you know, are things kind of just, I don't know, it's not right. Now, certainly when you're surfing, you know, big waves like this, it's probably pretty clear when it's a good day and when there's just nothing there. With trading, it can be a little harder, and it can also be easy for us to give ourselves confirmation bias, and we can trade in any market. You know, you really can't surf if there's no wave. So if the sea is just calm as can be, you know, if there's no wind, I mean, what are you going to do? There's nothing to do. But with trading, there's always, every day, the market's open, there's always stocks moving, so there's always that opportunity, if you really want to find something to trade. And so we can sometimes get that confirmation bias, and when we do that, we'll often find ourselves trading very poor quality price action, taking unnecessary losses, and getting pretty frustrated. Now, when it comes to ascending and descending support and resistance lines, I do use these a lot more intraday than on the daily chart. They can be a little subjective. Different traders draw the lines in different places. As a result, they're not always really obvious. So a stock like GoPro that is very popular and has a cult following, the lines will probably be a little bit more well respected, because I'm probably not the only person that drew the line like this. You know, I connected this high here and this one here, and then that extended it forward to here. I connect the lines here and here, and that extends it forward to here where we see that bounce. So these are fairly obvious in this chart. We can see that we definitely have a channel that we're trading within. That's pretty clear to see. In this case, the S&P 500 has, you know, a little bit of a support channel here, ascending support, descending resistance, depending on how you draw the line. Again, sometimes these are obvious, sometimes they're not. This is one that I had drawn, I think, from a candle further back. And so this was a good example where it actually came kind of right to the penny at that level. That's not always common, but in that case it did. Here, connecting these lines down here, or maybe, I don't know where this was connecting exactly as I'm looking at it. Maybe it was, I'm not sure where, but you can see that there was some respect of that level in these areas here. And then, of course, on this day here, this would have been what we would consider a pretty strong daily chart. We're certainly above the 200. We've got some nice little windows, nice gaps. Not a bad chart. Ascending, connecting here, and then that connects forward to here. So that becomes kind of obvious in this instance. So connecting here comes forward down to there. Connecting these ones comes forward to here. So you can sort of see how we have a little bit of an issue there on that day. So how to draw a trend line. in addition to support and resistance triggers formed by candlesticks, the highs and the lows, those are the horizontal ones, we also do find support and resistance from trend lines. Trend lines are angled, and they connect to several candles. A trend line gains validity the more times that it's been tapped. Just like a flat top breakout that's been under that level for, well, I had General Electric on here, just pop that up there for a second. Look at this flat top breakout there. At 11:15, it hit once, twice, 3, 4, 5, 6 times before breaking. Now, it only broke by like 3 cents. Wouldn't have been enough for profit, but you can see how that was very clear. So the clearer the obvious that they are, usually the better that they'll be respected. So let's see. Why don't I, before we get into 5, why don't we do some trend line drawing and break down, well, why don't I just do some trend line drawing? Well, you know what? Why don't we do, sure, we'll just do it. Okay. So let's look at GME, which has been just very, very volatile. Now, on the daily chart, this one really doesn't have any obvious ascending trend lines that I would see, or descending at this point. I mean, really, while you could draw a really steep one, like right here, I just don't usually draw them that steep. Those don't usually work as well. Let's see, Lizzie. So, on this one, I might initially kind of look from the high of that candle to this candle here, as a possible little area. If we switch this then to the 5-minute chart, we'll see how and where that level intersects, which was right about there. So you can see that it did have a little bit of an issue in that area. It broke above it, came back below it. And I would generally say that that's probably not a coincidence. So you can see that level there. We might see this level here. Now, come on. Look at that. Look at that. I mean, that's a perfect example, right? So by drawing these on the chart of the stock you're watching, it allows you to better understand potential profit targets and potential resistance areas. So in this case, that was a very well-respected line. It was picture perfect based on the daily chart. OCGN, this was a daily chart we were watching today. This one I don't really see a super obvious level. Again, a steeper line like this, I wouldn't usually draw, but you can see how, it kind of did trade underneath it and then kind of above it and right there, tap off of it. You could have drawn a similar one in this area, but I just don't usually draw them super steep like that. I don't know, for whatever reason, I just don't usually find when they're really steep that it's as easy for them to be well respected, because the stock in that context is selling off so hard or squeezing up so much. It just doesn't, it's just not as easy to sort of visualize. So yeah, right now I don't see one particularly on this one. I don't think that we had an ascending support issue, but now you can see kind of those 2 candles there, and you could always draw it back here and ask yourself, okay, well, does that line up back here? If I had connected, this one here and this one here, would that have brought them, and in this case, no, it comes too high when you draw it like that. Some of these lines back here, you draw it just slightly differently, and look at how much it moves, when you project it forward. So like that, actually seems to be dialed in pretty darn close. So I'll sometimes do that. You sort of have to adjust them a little bit, and then when it sort of is in and you're, okay, all right, that seems to be pretty accurate. It was respected pretty well in this area. So that line at the time was the high of this candle and then this candle, which, when this was happening, you probably wouldn't have had it drawn that way. You probably would have, maybe had it drawn like this, or maybe like this. But then, once we kind of move forward, and maybe you would have had it like that. But then, eventually when you're sort of up on these days in here where we had this gap, you might have looked back and said, well, where do these connect? And then drawn them like that. So, just the fact, though, that different people would draw them differently means that you might have, one line right here and another one right here. So on our 5-minute chart, we switch to the 5, we can see that level was correct. This one, it's hard to really tell if that was respected super well. Maybe, but I'm not really sure. MBRX is another one from today. So switch this back to the daily chart. Yeah, so we had that 930 level, but in terms of ascending or descending, I don't really see initially. I don't know, let's see. Looks like we have something there. So let's go back in to the 5. So, it kind of comes in around the same spot, right? So then that just, again, sort of reaffirms what we're seeing. So this is all technical analysis. So when we start adding these levels, you realize, wow, there's this pattern underneath all these charts that is there. We're bringing it to focus so you can see it. So you can sometimes just visualize without having to draw the line. Oh, we've got a level at 930. Drawing the line, if that's helpful, certainly you can draw it. Because technical analysis is such a critical component of the way we trade, the two things that are important for the way I trade would be my charts and then my trading platform. I guess that's kind of obvious, but in case it's not, the charts are important for me to have charts that are very easy to navigate. The way I can click on this axis and quickly size it like this, the way I can use my mouse if I need to roll it forward or back, the way I can very quickly snap and draw lines. This is not perfect software. There are some glitches that I don't love about it. TC2000, which I have to install on this computer to show you a demo of it, but I can do that at some point here. Well, we do a demo of it already towards the end of the pro classes, that if you just want to see the demo. I have it installed on this computer, so I just have to, but in any case, TC2000 is a little different in the way the charts work, and we know that TD Ameritrade is also a little bit different in the way the charts work, and you can get comfortable with them. The TD Ameritrade charts, the thing that I don't love about them is that they sometimes are a little hard to zoom in on certain areas. And then, I don't know, I just sometimes find them a little hard to navigate. But I think part of that is also just the learning curve, that kind of comes with trading and using different platforms. So now I'm kind of like lost on this. I'm like, wait, I can't, okay, I'm down here. All right, there, I guess that's a little bit better. Zoom back out. So in any case, you get used to what you get used to. But charts are important. Some brokers don't have very good charts. And so if that's the case, it wouldn't be a bad idea to spend, the money to use better charts. Okay. So a couple examples there, drawing trend lines. Hopefully that was helpful. And now number 5, blue skies. So when a stock is at all-time highs, we would say that's blue sky. Some people would say blue sky is anything above 52-week highs. That's not really blue sky, that's 52-week highs. To me, blue sky it's the highest the stock has ever been. It's never been higher. It's at all-time highs. For large cap stocks, all-time highs can be a little bit of a challenge because it's a place where people take profit as it's squeezing higher. Large funds may start to unwind some profit. They're happy with what they've gotten. For small cap stocks, 52-week highs and all-time highs, they're often seen more from this perspective of FOMO. The traders want to jump on the stock that's finally opening up, that's finally doing something exciting, and that has no upside resistance. And that's when things can get exciting. So blue sky is a little different with small caps than with large caps. Typically, blue sky daily charts perform best when the stock is a somewhat recent IPO within the first 2 years of trading history. It obviously performs best when we have a stock that has a really good catalyst and typically with a lower float, and on that particular day is one of the top 2 or 3 stocks that everyone is watching. I'll say, just as a side note, that when the market is really hot, sometimes you'll see a stock that, the top 2 stocks are getting a ton of attention, and, the 5th stock down, nothing's really happening. But it has a great catalyst. On any other day, if that was the leading stock, it would be the one that everyone's focusing on. But on this particular day, there are, 2 stocks a little further, ahead. It's probably how every student feels when they get to Harvard, because most likely at their high school, they were in the top 10. And now they're in, an entire school of everyone's the top 10. So, you're no longer the star of the show. Because a lot of times we have these stocks where on another day, everyone would have been so excited about it. But today, you've got 5 others that are just going absolutely bananas. And so, unfortunately, this one is taking a back seat. And it's also true that sometimes when the market is cold, we will see a stock that has a really good catalyst, and it just, people are too conservative. They're too cautious. They don't want to jump in. And so that same stock in a hotter market might have done a whole lot more, but in the cold market, traders were a little cautious. So from, a strategy standpoint, it makes sense why sometimes during hotter times of year, you see small cap companies putting out headlines more frequently, sort of working harder on their shareholder, sort of PR strategy to get the word out about their company. And during colder times of the year, we'll just kind of see a lull where we're just not seeing a lot of headlines. We don't usually see great news come out on Fridays because, people forget about it over the weekend. Usually you see great news come out early in the week. Bad news often comes out on Friday. So we hope that people forget about it by Monday. And these are sort of patterns that you notice in the market. And it's not necessarily a seasonal pattern that, it's always hot at this month and then it's cold in this month. I've had such variation between different times of year where I would typically say August is slower, but I've had some Augusts that have been amazing. And typically I would say the winter and fall and winter is better, and I've had some years where that's not been the case. So it's sort of a little bit more of a cycle than really seasonal. Here's an example of Blue Sky. So when this stock broke over $10, there was zero upside resistance. It was a new IPO, and it went from $10 all the way to $44 a share. So a lower float stock, presumably with a catalyst, although I don't remember at this time, and a very big move, as you can see there. The float on this stock as of today is 4.7 million shares, but it might have been lower at that time. CIIC from 10 all the way up to 38. It's a merger corp, so this is a special acquisition company. We'll talk about those a little bit more when we get into strategy. But special acquisition, when it comes to stock type, we talked about how they can sometimes be like trading an IPO because it's a company that is going to be going public through this special acquisition company. So it's this kind of reverse merger type of thing. And these can sometimes give us big moves. EH, all-time highs, makes a nice move right there as well. Here's a nice one. Above 1218 would be all-time highs, if it can break through that level. But as you can see, it has a bit of a history of the gap fade. So gapping up and then fading. And unfortunately, that history, could be a problem on this stock. We would obviously prefer that it didn't have that history if we were really thinking about being long bias on it. But if it does break over the high of 1218, that's certainly where we would say, all right, it's at least time to probably seriously consider it because it's bucking the trend of what it's done in the past. And then 6, former momentum stock, daily breakout. So a stock that was a recent former runner, former momentum stock, and has been consolidating around moving averages is something many traders may still be watching because those stocks will sometimes have a little bit of a cult following. No doubt GameStop is going to have a cult following for many months to come. Not that we're necessarily going to want to be trading it, but after a big move like that, you continue to see this just kind of heightened level of volatility. Kodak is another stock that has that at this point. They sort of got into the COVID space, or attempted to, with wanting to repurpose their factories for producing pharmaceuticals, and you can see how it went way, way up. But then even on the clear backside of that move, some days where you got, from 6 to 13, or in this area from 8 to 11. So, and even right now we would say, well, if this has a day where it can get above 14, you've got a little bit of resistance there, but then it's, it starts to look a little bit more interesting and start to move a little bit higher as you look at those windows back up towards all-time highs. Now, this company did something similar in 2017 where, or maybe 18, where they tried to jump on board the cryptocurrency excitement, and they went from $6 to, $13. So it is a former Momo stock, and definitely a stock that has a bit of a cult following. So this is one of those ones that, I wouldn't be keeping it on a watch list and looking at it every day, but I'm certainly familiar with the name. And So this is one of those things where getting familiar with all of the former Momo stocks kind of just requires a period of 3 months or 4 or 5 months of trading, because then you just start to notice, okay, there's Kodak. All right, there's GameStop. Traders from a while ago would remember DRYS and DCIX and GLBS and some of those shipping stocks. There's Lakeland Industries that makes biohazard suits. There's APT, also a maker of protective equipment for pandemic type of situations. So, we just have these history of stocks, the kind of basket of stocks in our mind that we just know, okay, these are former momentum stocks. But you can also pull it up anytime you're sitting there looking at your gap scanner in the morning. We go up to the gap scanner, top gappers, and we just go down the list. All right, so ARTL, is this a former Momo stock? Not really. MBRX, sort of. Red days, though. It gaps up and sells off. HOL. Takes a second for the charts to load. Not really, but blue sky. So perhaps, depending on the catalyst, but then we see the float is 37 million shares, so the float's a little higher. Sava. Now, Sava is a stock that has made some big moves, some big green candles. So this is one. AEZS. That's a little too cheap anyways. AREC, 24 million share float. There's a day it was big, but then sold off. So pretty quickly, just looking at the scans and then checking the charts, you can make a decision as to whether or not, it's really a former Momo stock. Now, a note on daily flag patterns on small cap stocks. Daily flag patterns, which would be a bull flag or a ABCD pattern, they can be strong. They can be, but I often find that usually I'm not trading them, because usually by the time they've consolidated and they finally formed this nice pattern, usually momentum has sort of moved on to a different stock. So, I would not say a daily flag pattern is by any means a requirement for a good trade. When we have one, it can certainly be nice, especially if it coincides now with fresh breaking news. But the daily support resistance levels based on gaps and windows, to me, are they're significant for typical gap and go momentum trades. They're significant for stocks that have a catalyst. For stocks that don't have a lot of volume or are just fading, they're just not as significant. So they're not something I'd really look at. And again, that just goes back to not wanting to spend a lot of time analyzing the daily charts of all the stocks out there, because what's more important is the intraday price action and the intraday catalyst. That will almost always override your daily pattern and your daily setups. So daily flag patterns on large caps, then that's a little different. Those can resolve a little bit better because of the institutional traders that may be looking for opportunities to take multi-million-dollar positions for the next leg up. But on small caps, we usually don't have that constant level of volume. What's more common on small caps is that these stocks have basically zero volume and then a huge spike. Large caps, they just generally have higher average volume. And yes, they have the days where the volume peaks, but just the general average is significantly higher, and that allows and accommodates for much more active trading around the daily levels. But we don't have that amount of volume on most small caps to justify taking the first candle to make a new high. There just aren't enough people watching them. So this is a former Momo stock on LEDS that I showed you earlier. This is another one here on Cali. This was a former Momo stock. Very clear on the daily chart, seeing those big green candles. Another former Momo stock here. Another one here. Another one here. Another one here. And you don't need to memorize these charts. Some of these are older and they're not really stocks that we'd be looking at this point. This was definitely one from $2 to $16. And then this sort of breakout here, which at this point would have been like, yeah, it's a former Momo stock. It's opening up. Let's jump on it. BioC, MBOT, TMSR, ADIL, here, BSPM, RKDA, LFIN. This pullback and then from 40 back up towards 80. That's a big move. MYOS, did I already have that one? Maybe. PPSI. And so while we have some really nice examples of some former Momo stocks here, this is the opposite. It's a, former fader. It's a former failure. It's a stock that pops and fades. So this gap fade history, every time it gaps up, it fades. traders start to aggressively short these. You know, when you see that that's the pattern, then you trade that direction. It's always easier to trade with the pattern. And so this is, you know, the stock with a history of gapping and fading. Here's another one with a history of gapping and fading. Here's another one with the history of gapping and fading. And so, you know, we just see this, you know, on certain stocks for whatever reason, they just continue to gap and fade. Now on a day when the stock bucks that trend of being a former fader, former fail, former failure, whatever we call it, to really ripping, that can squeeze out short sellers and that can trigger a little bit of a move. But, you know, trying to predict that that's going to happen, most times they just continue to follow that pattern of gapping and fading. So in the next chapter, chapter 5, we're going to start getting more into the intraday chart patterns. And we're going to talk about the bull flags, bear flags, flat tops, flat bottoms, moving average pullbacks, and ABCD patterns. Again, the reason I don't really talk about those a lot on the daily charts because we're really not trading. While it's true that sometimes we will see, as was the case here on ADIL back here, you know, sometimes we will see a nice pullback pattern on the daily chart. You know, this one happens to be pretty clean. Usually that's not what we're seeing. Usually that's not what we're trading. Usually we're trading those stocks that just are kind of these sometimes one-hit wonders that just make huge moves and then fade, make huge moves and then fade. And, you know, that's just where we see peak volatility. So when we get into chapter 5 and we're talking about intraday chart patterns, you can understand that those patterns are perfectly valid on daily charts. There are times you will see them on daily charts, but I won't usually use them by themselves as the basis for my strategy or for my entries. So I suppose focusing on them on the intraday chart just makes more sense because there'll be so many more examples from my own trading that I'll be able to reference. And then you'll just know if you see that same pattern on a daily chart, you know, okay, well, we have that going for us. All right, so with that, why don't we go ahead and jump in here to chapter 5. And I think that this right here, with setting up our charts, just as to reinforce chapter 4, we're setting up our charts to give us the best understanding of context for current price action. Remember that charts are historical. They're telling us what's already happened. And we try to use that as some type of prediction of what's going to happen in the future. So we're trying to read these tarot cards of the stock chart to predict future price action. We can further reduce our risk as traders by focusing on chart patterns that we believe give us some hint at what's going to happen. Certainly in a stock like this, I can see without even drawing it that there's a very clear ascending support line that was sort of right in this area. So, you know, if the stock comes back up to this level, we just know that these are levels to watch. So charts are very important. They give us the context of the current price action relative to historical price action and with some degree of what we think might be coming next. So steps that you can take today, keeping charts simple is important. You can see I'm using very minimal indicators. My exponential moving averages, I don't use volume weighted average price on the daily because it's not even an option. VWAP is only an intraday indicator. So I just keep it really simple. Candlesticks, volume, exponential moving averages, and then looking for those ascending, descending levels in the pockets of no support resistance where we might get a big move. So start looking at daily charts of all the stocks that I'm trading each day and see if you can break down those nearby resistance levels. And of course, do the quiz here for chapter 4, and we'll move along to chapter 5.